For this session, we are to talk about your output VAT. So for output VAT, guys, remember when we had your introduction to VAT, to get for your VAT payable, we get your output VAT less input VAT. Okay. So this is your VAT payable. As I told you before, your output VAT mainly comes from your different sales, and your input VAT comes from your different purchases. So if you are a VAT registered taxpayer and you had sales, you have your output VAT. Okay? So what are the sources of your output VAT? So under the law, we have these three items that are the sources of your output VAT. First, we have your sales of goods, properties, or services. Next, we have your deemed sales. Next, we have your zero rated sales. Although we already touched upon your sale of goods, properties, or services before, we will still need to at least refresh our minds on what are these items. And then what is new for this output VAT is your deemed sales and your zero rated sales. So let's have a recap on your sales of goods, services, or properties. So remember, on your sale of goods or properties, we have your gross selling price. And what are the items again of your gross selling price? To compute for your gross selling price, we have your total sales, and then we deduct your returns, allowances, and discounts to get for your net sales. When we talk about your sales, this is either a cash sale, account sale, or installment sale. And for returns, allowances, and discount, still remember, this must be an actual return allowances or discount. Now, for your sale of service or lease, we have your gross receipts. When we talk about your receipts, we look into your collections. Okay. Now, also, a recap on your computation of your output VAT. It depends whether the sales is without VAT or the sales is already at invoice price. So if ever it is already in invoice price, what did we say before? If the sale is with invoice price, it means that the sale is VAT inclusive. Okay? But if ever it is only a sale without VAT, there is no VAT into it. So for example, our sale is 112,000. If that sale is without VAT, you have 112,000 times 12%. Our output VAT is equal to 13,440. However, if the problem states that that is already the invoice price, meaning it is already VAT inclusive, 112,000, you multiply it to 12 over 112, we have 12,000 pesos as the output VAT. Okay. So what is our assumption? If you are a VAT registered taxpayer, of course, your sales are always inclusive of VAT. So our assumption, if you are a VAT registered taxpayer, your sales is inclusive of VAT. Now, we said that your sales is either cash sales, account sales, installment sales, and dim sales. Normally, your sales before, as we have discussed, we only included these three items. But we insert now a dim sale. So you already know what is a cash sale, a sale that you receive in form of cash. Account sales, sales on account or on open account or sales on credit. Installment sales, sales made in installment. And lastly, your dim sales. This is the new item that is inserted under your tax code. So what is this dim sale transaction? So normally, dim sale transaction, if we try to discuss it later, these are different transfers, use, or consumption of goods or properties originally intended for sale or use in the business. Okay? So the transfer, use, or consumption of goods or properties originally intended for sale or use in the business. So this one, you have already a particular inventory. So those are goods or properties you intend for sale. However, you transfer it or you use it or you consume it, not considered as a sale to a third party. So normally, if there is a sale, I am the seller, there is a buyer. However, here in your redeem sale, the inventory or the goods or properties is transferred, used, or consumed, not in the ordinary way of sale, such as there is a buyer or seller. But these goods or properties, since they are already transferred, used, or consumed, is considered sale for the purpose of VAT. So although it is not an actual sale, it is deemed sale, therefore subject to VAT. Okay? So again, hindi naman talaga siya sale na buyer-seller. However, since yung normal na binebenta mo ay nagamit na or nilipat mo na sa iba or na-consume ng iba na hindi natin kino-consider na buyer, yung transaction na yon, i-consider natin sale for VAT purposes. Ang tawag natin doon ay deemed sale. So cash sales, account sales, and installment sales are all actual sales. But your dim sales is not considered an actual sale, but for VAT purposes, it is considered a sale. Okay, so we insert a new one here, which is known as your dim sales. Later, we will discuss what are the items of dim sales. So remember, your sales comes from these four items. So let's look into the rules on these items, such as your cash, account, installment, and dim sales. So, what are the rules on your sales? So, the rules on your sales, such as it is considered an actual sale, first, if there is an unreasonably lower sale. What is this unreasonably lower sale? There is an unreasonably lower sale if it is 30% less than the market value of that particular sale. So our tax base now becomes the market value. Now, why do we say that it is the market value? So actually, we base it on your market value, and this market value is based on the goods of the same quantity or quality that is sold either in your immediate locality or in the nearest date of sale. So pag titignan nyo yung market value, guys, you just do not look into the market value that is based on the current market price. So it's either based on your immediate locality, this is under the law, immediate locality, or the nearest date of sale. Okay, so for example, so you have here sold goods 500,000. Okay, and the market value in the immediate locality is 800,000. Okay. So first, we need to look if ever it is 30% less than the market value. So to get for that, you get the sales price over the market value. You multiply it to 100%. And you look if ever that is 30% or not. So we have here sales price of 500, market value is 800,000 pesos. Sales price is again 500, and then we have here 800,000 pesos. So let's look if ever it is based on a discount or not based on a discount of 30%. Okay, so let's check. So we have here 500 divided by 800. So multiplied by 100. This is equal to, wait, ano ba 'to? Ba't ayaw 500 divided by 800 times 100%. We have here 62.5%. So our percentage is only 62.5. 100% less 62.5. look into your discount is equal to 37.5%. So since we have a 37.5% discount, what is our tax base? So instead of your sales price, your tax base now is your market value. Your tax base now is considered your market value. So based on our market value, so we get that particular market value, that is the amount of our tax base. So 800,000 multiplied by 12%, what is the output VAT? 800,000 times 0.12, we have 96,000. That is the output VAT. That is an example wherein you look into your immediate locality. So we sell it at 500,000. However, in the market, in our locality, it is sold at 800,000. So to get for the discount, again, your selling price, you divide it to market value, you multiply it to 100%. So we sold it at 62.5% out of the market. 100% less 62.5%, our discount is 37.5%. Since this is 30%, more than 30% already, so at least or more than 30%, it is considered unreasonably lower. If that is unreasonably lower, you base it on your market value. Okay, another one. So what if we base it on your nearest date of sale? So for example, you have your different sales in units. 10,000, 100, 100,000, 8,000 units. Selling price 50, 48, and then 15. So this is 21, 25, and 28. Okay. So we base it on the nearest date of sale. So if the selling price is 50, 48, and 15, as you can see, the last item, 28, masyado na mababa yung price. Of course, you test that again. So 15 divided by 48, 15 divided by 48 multiplied by 100%. What is the percentage of our selling price as compared to your nearest date of sale? 15 divided by 48 times 100 give us 31.25%. 100% less 31 of less 31.25. We have here 68.75%. This is the amount of your discount. So, if ever sabi natin greater than or equal to 30%, it is considered unreasonably lower. So in this case, since it is 68.75, it is considered unreasonably lower. Now the question is, what is the market value that you will use? Sabi natin, if we are to look into your market value, the market value is dependent on your immediate locality or the market value in the immediate locality or the nearest date of sale. So our nearest date of sale here is 48. Therefore, this 8,000 should be sold at 48. Okay? So we got 48 here for the 8,000, 100,000 times 48, and 10,000 times 50. So how much then? 10,000 times 50, 100,000 times 48, and 8,000 times 48. We have 5,684,000. So this 5,684,000, we assume it is inclusive of VAT or exclusive of VAT. So it depends on the problem. So if it says that that is already your invoice price, then you divide it and you multiply it to 12 over 112. Again, pag invoice price na sinabi dyan, tong selling price na yan ay yung invoice price, i-multiply mo ng 12 over 112 to get for the output VAT. But if the problem tells you that it is only a price, it is not your invoice price, you multiply it to your 12%. For this case, let's assume that this selling price is not inclusive of VAT. Therefore, it is exclusive of VAT. Then we need only to multiply it to 12%. So our output VAT is 682,080. Okay? First rule, on your actual sale. If ever the sale is unreasonably lower or it is 30% less than the market value, then our tax base now is not the actual sale but the market value. How do we determine the market value? It depends whether it is in your immediate locality, the market value in the immediate locality, or the selling price or the price based on your nearest date of sale. So we already had an example on both your immediate locality and your nearest date of sale. So just remember how to compute for the discount. First, compute for the ratio of the actual price to your basis, whether that is immediate locality or nearest date of sale, and then you deduct that amount to the 100% to compute for your discount. If it's equal or greater than the 30%, it is considered unreasonably lower. Next, sale of real property. In your sale of real property, the tax base is the higher between the selling price or fair market value. So normally, if that is an actual sale, whatever is the sales price, that is the tax base. However, another rule on your sales, if what you have sold is a real property, your tax base is the higher between the selling price and the fair market value. Question: what is again your fair market value? Your fair market value is your zonal value or your assessed value. If you still remember, this rule is also the rule in your capital gains tax on the sale of a real property. So the rule on the sale, whether it is made on the ordinary course of the business, such as this type, or a sale that is not made in your ordinary course of business that is considered as a capital asset, we still make use of the same rule. The rule is that the tax base is the higher between the selling price or the fair market value. Remember, sa CGT yan din. So dito sa VAT, yan din. The higher between the selling price or the fair market value. So again, how do we determine your selling price higher between your selling price or fair market value? So let's say you sold a lot, 1.8 hectares. The selling price is 500 pesos per square meter. And then the zonal value is 600 per square meter. And then the assessed value is, let's say, hmm, 12.6 million. So yeah. So lot, we sold a lot, 1.8 hectares. It is 500 per square meter. This is our selling price. Our zonal value is 600 per square meter, and our assessed value is 12.6 million. So you just need to get the higher between these two. First, you need to multiply the 1.8 hectares to the price per square meter. How many square meters are there in a hectare again? 10,000, di ba? 10,000 multiplied by 1.8, 18,000 times 600, this is 10.8 million versus 12.6 million, which is higher, 12.6 million. Next, the selling price, of course, lower na yan, 500 times 1.8 million, 1.8 times 500, we have 1.8 times 10,000 times 500 is 9 million. So the higher is 12.6 million pesos. The higher is 12.6 million. So if this is 12.6 million, that is our tax base. But take note, guys, in a sale of real property, the selling price is considered presumed to include the VAT inclusive. But the fair market value is presumed to be VAT exclusive. So in our example, we have 12.6 million multiplied by 12%, 12.6 times 12%, we have 1,512,000 pesos. 1,512,000 pesos. Okay, so in our example, the fair market value is higher. So sabi natin, it is VAT exclusive, kaya minultiply natin ng 12%. Another example, your selling price is 5 million. Your zonal value is 3 million. Your assessed value is 4.5 million. So higher on your FMV is 4.5 million. 5 million versus 4.5, 5 million. So the 5 million is the selling price. So if that is the selling price, sabi natin, it is considered VAT inclusive. If that is VAT inclusive, so multiply by 12 over 112, how much is our output VAT? 5 million times 12 over 112, we have 535,714.29. Again, on your sale of real property, what is the rule? The tax base is the higher between selling price or fair market value. If ever the higher is selling price, it is considered VAT inclusive. Kaya dito, nag-multiply tayo ng 12 over 112. Pero pagka yung higher naman ay FMV, it is considered VAT exclusive. Therefore, 12.6 million, yun yung FMV, minultiply na lang agad natin sa 12%. Okay? Again, rules on your actual sale. So these are the following rules that we apply on your actual sale, whether it is a cash sale, account sale, or installment sale. If ever it is unreasonably lower, we use the market value. The market value basis, it's either your immediate locality or the nearest date of sale. On the sale of real property, the tax base will always be the higher between selling price or fair market value. This rule is the same among all of your real properties taxation. So whether it is CGT or VAT, it's still higher between selling price or FMV. Now, if ever the higher is their selling price, it is considered VAT inclusive. If it's VAT inclusive, you multiply it to 12 over 112 to get for the output VAT. If it is FMV, it is considered VAT exclusive. You just multiply it to 12%. Okay? So we're done on your rules on your cash sales, account sales, or installment sales, or your actual sales. We go now to your sale considered as deemed sale. Okay. So we have here your deemed sale transactions. So a while back, sabi natin ha, your sales include cash sales, account sales, installment sales, deemed sales. We have already discussed before in your introduction what is a cash sale, account sale, and in your installment sale. What is new here is your deemed sale. However, in this particular session, we talk about your rules concerning your different sales. So we're done with the three. We are now on your sale on deemed sale transactions. What is a deemed sale transaction again? There is a transfer, use, or consumption of your goods or properties that is intended for sale, not in the ordinary course of business. So in short, it is not a transaction in which there is a buyer or seller in your ordinary course of business. And what are these transactions? So we have the following transactions. First, we have your consumption of inventory. Next, your distribution to stockholders. Next, distribution to creditors. Next, we have your consignment of goods. Next, retirement of business. Next, cessation of that status. Tandaan lang, meron kang goods or properties na dapat ibebenta, pero instead na nabenta mo to a buyer, ito ay naibigay to other persons not considered as buyer. Okay? So it is transferred, used, or consumed by other persons not considered as your buyer. So what is the tax base once we say it is already considered a deemed sale? It is your market value of goods. What is important on your deemed sale transactions is for you to determine whether that particular transaction should be considered as an item of your sales or not. So these are the following deemed sales. So again, your sales includes cash sales, account sales, installment sales, and your deemed sales. So you just need to know what are the different deemed sales. So here are the following transactions: tax base, market value of the goods. So let's start first with your first deemed sale transaction. So we have your consumption of inventory. So goods intended for sale but are used or consumed for personal use by the taxpayer. So sabi nga natin, pag sinabi nating deemed sale, it is a transaction regarding your inventory. However, it is not sold in the ordinary course of your business, but it is transferred or used or consumed by other persons not considered your buyer. So in here, we have here your inventory, but used for personal use. Normally, these are your different withdrawals of the owner. So what is withdrawn here is your inventory. Guys, Pag nag-withdraw yung owner ng inventory, isasama natin yun sa pag-compute ng ating output VAT. Okay? So, how to compute? If in case, you just add the value, get the market value of that particular uh, transaction. So for example, we have here your sale or transaction to your other buyers worth 3 million pesos. And then the owner withdraw goods costing 500,000 with market value of 800,000. Okay. So here, although we have this actual sale, we also include a deemed sale. What is the deemed sale? This is the withdrawal of the owner. What is the amount? 500 of the market value of the goods. 500,000 of the market value of the goods. 500,000 cost, 800,000 market value of the goods. So sale of 3 million and the market value, which is 800,000. What is the total subject to VAT? So VATable sales is now 3.8 million pesos. Okay? So deemed sale. Another deemed sale, distribution to stockholders. So transfer of inventory to shareholders as share in the profits of a VAT registered person is considered a transaction deemed sale. So this is more of a property dividend. Okay. So if you have a property dividend and the property is an inventory, take note again, there is a transfer. There is a transfer. However, the transfer here is not a transfer to a buyer, but transfer to non-buyer. So the non-buyer here is the stockholder. We still consider them as deemed stale. So if ever we have a property dividends in the form of inventory, we again include them. Okay? Tandaan lang, deemed sales should be included on your total sales. Another deemed sale, distribution to creditors, transfer of inventory in payment of debts constitute transactions deemed sale. This is the Sean and Pago, the Sean in payment. So you use instead of paying in cash, you use your property. So here you use your inventory as payment. Inventory as payment. Again, if that is an actual sale, we have your transfer, use, or consumption to a buyer. However, in a deemed sale, the transfer, use, or consumption is to a non-buyer. Who is our non-buyer now? The creditor. So let's have a review. Our first non-buyer, it is the owner. Our next non-buyer it is the stockholder. Our third deemed sale, it is the creditor. Okay? Next. Transaction deemed sale. So this is consignment of goods. Among all other types of your deemed sale transactions, although here in your consignment, remember it is not actually a buyer, 'di ba? In a consignment, so we have here a consignor and a consignee. Remember, in a consignment, there is no actual sale because the consignee must, of course, sell it first to a third party buyer. Okay. However, unlike the other three, if ever nag-withdraw si owner, if ever nagbayad ka kay stockholder or nagbayad ka kay creditor, it is already considered deemed sale. Dito sa consignment of goods, there is a requisite. The actual sale, di ba sabi natin, we have a consignor and consignee, and we have a third-party buyer. Now, if the actual sale is not made within the 60 days from the time you consign it, it is considered deemed sale. So, unlike the other three, once you transfer it, it is considered deemed sale. Here, sorry, ba yan? Upon transfer, what did we say? It is not yet considered deemed sale. When is it considered deemed sale? 60 days upon transfer and it is still unsold. Okay? So if the actual sale is not made within 60 days following the date such goods were consigned. So Unlike the other three, once you transfer it, give it to the owner, give it to the stockholder, or give it to the creditor, it is already considered deemed sale. In this case, it is not considered deemed sale. It is only considered deemed sale upon 60 days from the date of transfer. So let's say you have transferred goods for consignment. So January 1, uh, inventory as of March 31. So the following are the transfers. January 15, you have 10,000. Uh, February 1, 31,000. March 15, 60,000 pesos. So, transferred goods for consignment, inventory as of March 31. So, ibig sabihin, itong January 15 na transfer, as of March 31, tong January 15, hindi pa nabebenta. February 1, hindi pa nabebenta. March 15, hindi pa nabebenta. So, what is considered deemed sealed? So, you need to look 60 days upon transfer. So, January 15, what is the 60 days after? The 60 days after is January 15, 31, 16, February, sabihin natin 28, tapos March 31. Ilang days yan? 16 plus 28 plus 31, that is 75 days. So this is already 60 days upon transfer and is still unsold kasi nga inventory siya. So this is considered deemed sale. Ito February 1, 28 plus 31, so we have 59, not yet a deemed sale transaction. Next, March 15. So we have 16 days, not yet a deemed sale transaction. So we have here a deemed sale transaction. Again, what you need to look in a consignment, unlike the others, upon transfer, it is considered deemed sale. Here in your consignment of goods, it is not considered a deemed sale upon transfer. When is it considered a deemed sale? It is only considered a deemed sale 60 days upon transfer and it's still unsold. So in our example, we have here inventory as of March 31 on your consignment goods. So we have consigned on January 15 until March 31 still unsold. So the 10,000 is considered deemed sale. So what is important here guys is for you to compute the date of transfer up to the date of your inventory. So after the date of your inventory, if it's not sold yet, it is considered deemed sale. So if ever it is based on your days, so computing nyo na lang. Pero pagka month yan guys, if sinabi lang January, February, March, ang treatment is it is considered transferred on the first day of the month if it's considered monthly. Okay? Considered monthly. It is considered sold at the first day of the month. So let's say January, February, March. January, that is already considered 60 days. Mga ganun. Okay? Dim sale. So we have already discussed four dim sales. First, on your owner. Next is stockholder. Next, creditor. Next, consignment. Okay. Fourth one, retirement of business. Here, this is also considered as transfer. However, in your transfer here, due to retirement. Remember what is the exempted transfer only? The exempted transfer is the transfer on a business combination. In a retirement of business, we are not to create a new business, but we end the life of the business. Therefore, it's still taxable. So in your retirement of business, the merchandise inventory left at the retirement of business is deemed sold for VAT purposes. However, take note, the tax basis on the four items we discussed, that is the market value. However, dito kasi, since mamamatay na nga lang yung business, itatax mo pa ng mas malaki, di ba? So, ang sabi naman ng ating law, you should tax it at a lower amount already. So, what is the tax basis now? It is the acquisition cost or current market price, whichever is lower. So, unlike the four items, so we have here transactions to the owner, stockholder, creditor, and then we have your consignee, the uh, tax. It is tax upon transfer, upon transfer, upon transfer. This is 60 days. Tax basis, In your owner, it is your market value, market value, market value, market value. How about your retirement in your business? So here again, there is a transfer. However, this is like a transfer to the owner. Sir, what's the difference between the transfer on the owner on the first one and the retirement? In your transfer in the owner, there is still a business. However, in your retirement, of course, it will be taken by the owner, right? However, here, the business will already die. So there is already the death of the business. So the tax is upon the transfer, and the market basis is the lower between the cost versus the market value. Okay? So take note of these different deemed sale transactions and the rules. So we outline now the five items that we discussed. So in a retirement of business, although there is a transfer here such that the transfer will be to the owner, but take note the reason is not because of the withdrawal of the owner, but because of the retirement on the business. Now, what is the tax basis? The cost or the market value, whichever is lower. And the last deemed sale transaction, cessation of VAT status. So when we say cessation of VAT status, that is either from VAT to non-VAT. When can we say you are non-VAT? If you are a percentage tax payer or you are a VAT exempt now. So VAT to non-VAT. Although VAT exempt is not considered non-VAT, but still, you are not paying VAT already. So from VAT to percentage tax payer, so VAT to non-VAT, or VAT to VAT exempt. So once your status changes, it is also considered deemed sale. But take note, from your owner, stockholder, creditor, consignment, retirement, and then we have here cessation. When to tax? So upon transfer, 60 days upon transfer is still unsold, upon transfer, upon transfer. The tax basis, market value, market value, market value, market value, market value, or the cost, whichever is lower. But here, in your owner, stockholder, creditor, consignment, and retirement, what is included as part of your tax is the transfer of the inventory. However, in your cessation, dalawa. Inventory, including your capital goods. Okay? So, take note, when we do business, what we normally sell is the inventory. Kaya nga, ang dinidim sale natin pagka may nagtatransfer ng inventory. An exemption to that rule is in your cessation. What is transferred here is not only the inventory, but also the capital goods. So whatever are the capital goods that is also transferred because of your cessation, it is subject to your VAT deemed sale transaction. What is the tax basis? The lower between market value or cost. Okay, so let's recap the deemed sale transactions. So here we have your uh, transactions to your owner, stockholder, creditor, and consignment. All tax basis is market value, and it is taxed upon the transfer. However, for consignment, take note, you will only tax it or place it as part of your deemed sale upon 60 days. 60 days from the date of consignment and still unsold. Now, for your retirement from the business, the transfer of inventory again is subject to deemed sale transaction. However, the tax basis now is the lower between your market value or the cost of the inventory. In cessation, what is different among the other deemed sale transactions? It is on properties intended for sale or use in the business. This is your inventory, and we include also your capital goods as part of your deemed sale transaction. Okay, so again, what are the sources of output VAT? We have your actual sales, we have your deemed sales, and we have your zero rated sales. So we're done with your actual sales, we're done with your deemed sales. We are now going into your zero rated sales. We go now to your zero rated sales. So again, as we said a while back, your output VAT comes from your three different items. We have your sale of goods, your normal sale of goods. We have your dim sales, and we have your zero rated sales. So we go now to your zero rated sales. So the first zero rated sales that we talk about is your export sales. And then the second zero rated sales that we will talk about is your effectively zero rated sales. So if you are asked what are the two types of zero rated sales, you have only two. That is your export sales and your effectively zero rated sales. So what is the treatment on these export sales and effectively zero rated fields? So remember, guys, in your destination principle, we said that exportation is exempt from consumption taxes. However, as you can see, we now subject it under VAT, diba? So before we said that exportation is exempt from business taxes or consumption taxes. However, as you can see now, export sales is subject to zero rated sales. However, actually, even if it is considered zero rated or subject to VAT, effectively it is still exempt. Why? Because it is zero rated. When we say zero rated, your VAT normally is 12%, right? If it's said zero rated, your rate is 0%. So although it is an item of VAT, effectively it is still exempt. Effectively, it is still exempt. Why? Because your tax rate is 0%. You will not pay any tax. So still, it follows your destination principle. However, it is not part of your exempt transactions. If you still remember your exempt transactions, we did not discuss any export sales there. So here again, take note, although it is subject to VAT of 12%, or it is said to be subject to VAT, but effectively it is exempt because it is called zero rated. When it's zero rated, it is only two items. Export sales, effectively zero rated sales. So again, soon when you look into your different transactions as to sales, if you are given your actual sales, remember the rules, the 30% rule and the real property rule, and then your deemed sales. Remember again the rules, especially the tax basis. Now, the last one is your zero rated sales. This is easy. Once you know the different zero rated sales, export sales, you have only three. Effectively zero rated sales, you have only one item. Once you know that, it is subject to 0%. Actual sales, dim sales, subject to 12%. We know that one already. Zero rated sales, subject to 0%. Okay, so let's take a look into your different export sales. So let's start first with your first export sale, direct export. So what is a direct export? Of course, from Philippines to a foreign country. Okay, but not all direct export is considered zero rated sale. There is a requisite for us so that the sale or the actual shipment of goods from the Philippines to the foreign country is considered zero rated. When is it considered zero rated? So if it is exported from Philippines to foreign country, it is considered zero rated if ever it is in foreign currency, paid in foreign currency. And next, it is properly accounted with the rules and regulations of the BSP. Actually, don't look into your BSP rules already. That is only for theoretical purposes. For problem solving, just take a look into your different exports. If ever it is paid in foreign currency, then it is considered zero rated sale. So the following are exports of a Philippine company. So let's say the following are exports of a Philippine company to China. You are paid 500,000 pesos. To US, you are paid $10,000. To UK, you are paid 2,000 euros. Okay. And to Japan, you are paid 200,000 pesos. Okay. So they are all considered direct export. Why? From Philippines to a foreign country, to China, to US, to UK, and Japan. However, take note, as a rule on your export sale, we will only include those paid in foreign currency. So the 500,000 pesos and 200,000 pesos export sale is not considered zero rated sale. What is considered zero rated sale? Only these two items. So this is zero rated. When we say it is zero rated, we do not have an output VAT. Hence, here and here, we have an output VAT. Okay, again, direct export. Once there is a sale or shipment of goods from the Philippines to a foreign country, and it must be paid in a foreign currency. So here in our example, Philippines to China, to US, to UK, and Japan. While the sale to Philippines to China and sale Philippine to Japan is in a Philippine peso, it is considered subject to VAT. It is not part of your zero rated sale. Why? Because this export sale must be paid in foreign currency. This one is paid in foreign currency. This one to UK is also paid in foreign currency. Therefore, zero rated. This China, 500,000 and this Japan, 200,000 pesos. Since they are not paid in foreign currency, they are subject to VAT. Okay? So here, in your direct export, what is the rule? If paid in foreign currency, 0%, it means zero rated. But if the direct export is paid in our Philippine currency, it is now considered variable. Why? Because what we give only here is an incentive to those foreign currency deposits. Remember, one of our measure of purchasing power is our foreign currency deposits. So the level of our foreign currency deposits is dependent on our purchasing power. Therefore, as an incentive so that we have more foreign currency deposits, we give zero rating to a foreign currency sale. So only those uh, paid in foreign currency. So export, next, sale to separate customs territory or enterprise zone. So if you sold to a separate customs territory or a tourism enterprise zone such as your PEZA, SEZA, we have in Baguio, right? What do you call that in Baguio already? In Burnham? Basta, we have in Baguio. So if ever your sale is to a custom territory or an enterprise zone, basta meron kayong makita ng SEZA, yung may mga SAZA, ganun. PEZA, uh, basta yung may mga ZA, Economic Zones Authority, they are considered zero rated. So once you see, for example, sale, tapos nilagay dito to the government, to buyers lang, ganun. Tapos nakalagay to PEZA. Tong PEZA, 0%. Okay? PEZA, 0%. Next, sale to international shipping or air transport operations. So if you still remember, we have a particular exemption as to this international shipping or air transport operations. What is that exemption? The exemption here before is the importation, if you still remember. However, what is subject now to zero rating here is the sale. What is sold again here? The goods, supplies, equipment, and fuel. Remember this? If ever you imported supplies, equipment, fuels for international shipping or air transport operations, you are exempt. Importation yon. But if you sold goods, supplies, equipment, including fuel, for international shipping or air transport operations, it is zero rated. So we have three transactions considered as export sales. First, direct export sale to customs territory or enterprise zones. Next, sale to international shipping or air transport operations. Once you see these types of sales, so halimbawa, nagbigay ng different sales, sales to customer A, sales to customer B, sales to customer C, sales to PEZA, sales to US customer paid in a foreign currency, blah, blah. So different sales. You need to look whether that sale is considered an actual sale, a deemed sale, and an export sale. Remember, actual sale, subject to 12% output VAT. Deemed sale, subject to 12% output VAT. Zero rated sale, subject to 0% output VAT. So we're done with the first 0% output VAT export sale. Next, another type of zero rated sale, although it's not considered export, it is effectively zero rated. When we say effectively zero rated, if you sell to these particular transactions or or if you sell to these different organizations subject to laws and international agreements, it is subject to zero rated sale. So sales to persons or entities whose exemption under special laws or international agreements to which the Philippines is a signatory is subject to zero rate. So if ever we are a signatory based on a special law or an international agreement, we subject them to zero rate. What are the example of these different types of effectively zero rated sale? We have your sales to International Rice Research Institute, sales to UN, WHO, World Health Organization, UNICEF, Red Cross, what else? Different embassies. Okay, so those items which we have international agreements are subject to zero rated. Again, soon guys, when you are confronted with a problem, you look into the transaction. Okay, so this is the transaction which is considered a steal. Look if ever it is exempt. If it's exempt, then no tax. If it is taxable, you look into whether it is an actual sale, 12% output VAT. Deemed sale, 12% output VAT. And then zero rated sale, 0% output VAT. We have only two zero rated sale, export sales and effectively zero rated. So you look into the sale guys, if it's direct export, is it on a particular ecozone or an air transport operation as to your equipments or fuels, or that organization wherein you sold the goods is subject to international agreement or special laws. What are those again? International Rice Research Institute, embassies, Red Cross, UN, WHO, UNICEF, anything that we have international agreements into. Okay? Effectively zero rated. So let's look into the difference now of a VAT exempt or zero rated, because again, you might be confused on the exemption and zero rating. I told you on your exemption, based on your destination principle, export sales should be exempted. However, only those under letter A until letter double A are exempt. Okay. So to make that particular export sale considered or effectively exempt, we subject them to 0% output VAT. So what's the difference between a VAT exempt and zero rated? If that is a VAT exempt, there's no output VAT. It is exempt. However, the input VAT is treated as an expense. If that is a zero rated VAT, there is also no output VAT, 0%, but the input VAT is, is either tax credit, meaning it is deducted deducted to your output VAT, or it is refunded. When is it refunded? So for example, you have your output VAT, you have input VAT. Input VAT now is greater than output VAT. The greater is because your output VAT is 0%. Normally kasi, di ba? Because here again, take note, the input VAT can be claimed. Since we can claim it, if you have 0% output VAT, edi zero yan. Mas malaki na yung input VAT mo. So what will happen? So you can make use of it as a tax credit. You deduct it to your output VAT if you have any other output VAT, or if you don't have any other output VAT, or your input VAT is greater than output VAT, we refund it through a tax refund. So for example, we have here a direct export to US, $10,000. Cost of inventory sold is let's say 500,000, 560,000. This is already VAT inclusive. Okay. So what is our output VAT? That is the sale to US. So direct export. So it is 0%, right? So zero yan. input VAT natin dyan sa sale na yan, cost of the inventory sold is 560. So, our input VAT is 560,000. This is VAT inclusive, di ba? So, divided by 1.12 times 0.12. So, 560 multiplied by 12 over 112, we have 60,000. Okay. So, as you can see now, since it is zero rated, you have no output VAT. You have no output VAT. And then, you have an input VAT, 60,000. So the input VAT now is greater than your output VAT. What is the treatment? If you have other output VAT, let's say your other output VAT on your sales is 900,000, you can make use of that. We call that tax credit. But if in case you do not have any other output VAT or the input is already an excess, it be it will be considered as a tax refund. So you will just refund it. So in our example, we have zero output VAT, we have 60K input VAT, you can refund the 60K. So there are two treatments. If ever it is zero rated VAT, it can be used as an input VAT credit if ever you have other output VATs to make use of it. But if you don't have any output VAT to make use of that input VAT, you can refund it. So you can refund the 60,000 pesos. Okay? So let's look into your different transactions which gives rise to your sale. So we have your exempt sales, we have your actual sales, deemed sales, and we have your zero rated sales. So as to your output VAT, exempt sales, zero because it is considered exempt. Actual sales, 12%, depending on your tax base, or 12 over 112 multiplied by your tax base. Deemed sales, this is 12% again, depending on your tax base, which is either your market value or your cost or market value, whichever is lower. Zero rated sales, 0%. Now, as to input VAT, exempt sales, no input VAT. Actual sales, there is input VAT. Deemed sales, there is input VAT. Zero rated sales, there is an input VAT. So there we outline now the differences of these different sales as to your output and your input VAT. Take note, guys, for output VAT, you just need to determine the different types of sales, whether we should uh, whether we should subject it to VAT or we should not subject it to VAT. So remember the items of DIN sales. Remember the items of zero rated sales. No problem in your zero rated sales. You have only two items. On your DIM sales, madali lang naman, di ba? We have your owner, we have your shareholder, we have your creditor, we have your consignee. We also have your retirement in the business and then cessation of your VAT. Zero rated sales, we have your direct export, we have your sale to your customs territory and enterprise zones, and your international shipping. Also, you're effectively zero rated. That is those sales subject to international agreement or subject to law, such as your uh, embassies, Red Cross, ERI, Asian Development Bank, and etc. Okay? So that's it for your output